Okay, I'd like to welcome everyone out to Tuesday night, August 7th, 2018. Welcome to the Hurley Investments Financial Services Commentary. It's where our firm, Hurley Investments, go through a little bit about what we see. We try to pick a couple different comments to bring to your attention. More importantly, we're obviously just trying to give our clientele and those that attend an understanding of what we see in the market and what we plan to do to obviously do the best to make money in this market. So, if I was to ask you, starting off today, for that picture, I'm going to go ahead and I'm going to move it down just a little bit. If I was to ask you about this picture here, what could you tell me? What is this picture depicting? Very few stocks are leading us up. I'll buy that one. An abnormal profit for the S&P 500. 5 stocks dominate. So obviously you're correct. So the correct answer is obviously year to date, 5 companies are responsible for over half of the S&P 500 gains. In fact, I could pull you down to a chart that's very similar to it. But we're going to go over this here in a quick second. Where is it? Where the top 20 stocks, are responsible for 66.42% of all of the S&P 500 gains year to date. So an interesting point or two to mention, if I can go back up. What does this mean for portfolios? Let's put 2 and 2 together here. What does it mean for portfolios? Maud says danger. Lance says a potential big drop. I'd buy that one. Steve says not good. So, Steve, how's that not good? Maud, why is this dangerous? Lance, a potential big drop. What do you guys mean by that? You're all correct in a roundabout way, but that's not quite what I'm looking for. A couple question marks, okay. This is the new pattern. I personally doubt life is always asymmetrical even if we don't like it. So let me put a couple comments here. If you are trying to beat the S&P 500, you have to be overweight or unbalanced with having a FANG stock or 2 in your portfolio, right? This is why a mutual fund, a 401k, a 401k or a typical blended ETF even won't beat the S&P 500. Another comment. This is why small accounts less than 100K are so hard to grow. Difficult to be fiscally responsible in diversification without being able to own higher priced growth or momentum stocks. Now, does that mean that some of these portfolios can't do that? Of course not. A couple years ago, due to Netflix and the smaller portfolio, Nvidia, we did really good. We were doing like 60% growth. It's why we're stuck in Ford. We're stuck in Ford right now, waiting for Ford to come back. If Ford could just give us a yearly high, not even a yearly high, a high of $13, my smaller portfolios will knock it out of the park. At the same time, though, some people give me a call every other day. Oh, Kevin, we didn't beat the stock market today. And my polite answer is no kidding. At no point in time have I ever promised someone that I'm going to beat the stock market on a daily basis. In fact, for the most part, most people are looking at a yearly return. And there are times when I do have to remind people that, hey, this is a yearly return. Give it some time. But what we see right here, and I'm going to go on down to my other position here. We will probably have a little bit of a run into October, and then there's a high probability that our house of cards is going to come down. If you ask Ron Paul, it's a 50% drop. If you ask Soros, it's a 35% drop. Whoever I showed last week's already down 18.5% for the year. It's just, there are some things to point out that some people may want to take a peek at. We're in a bullish trend, coming up to some all-time highs on the S&P 500. If we hit the top of our trend line, we might pass our yearly highs. But technically speaking, we're running into some points that make me fearful. And it makes me fearful because our market shouldn't be on a growth pattern that it is right now. And of course, that growth pattern is based on some unique circumstances. Unique circumstances like being very heavily funded with easy money. And I believe it was Ma that made the comment, no problem beating expectations. Earnings per share, unless you're Disney, and I'll go over that in a second. But no problem beating expectations because of the tax breaks. The amount of money that's being saved is huge. But that's making next year's comps almost impossible to beat. So while we're making the easy money now, next year looks awful, and mark my words, it would not surprise me to see a huge drop next year. A correction that would justify at least a 35% drop. I'm not sure that we would see, I'm not sure I see a 50 like Ron Paul, but mathematically he's correct. In fact, I can't remember who it was, but mathematically, yes, we could see a drop or a pullback all the way back down to most likely 1285 to 1355 on the S&P. Now that is just a mathematical equation, doing nothing more than pulling out the stimulus or the false growth, and I'll show that one to you here in a minute, what that chart looks like. So yes, there is a mathematical algorithm that would tell you, hey, our market could lose as much as 67 point something percent. It's like 66 and change. I can't remember exactly. It changes. But the good news for us, we do have significant support at 2740. We're also testing the 2800. In the short term, we've got a chart that could lead to yearly highs. And it's funny because they're doing it using the Williams percent R, the MACD, and they're also using the RSI. If you take a notice, I must admit I do think it's kind of funny. If you look over here on the left, hopefully you can see that. What moving averages do they have there? What moving averages do they have there? The 50 and 200, that's correct. Those are the easy ones. Can you see in the middle? They've got a 75 and a 100-day moving average. Can anyone tell me who uses a 75 or 100-day moving average to make a decision? Good comment, Lance. No one I know. Mary, I don't think big institutions use that. Both of you are correct. I don't know, nor have I ever seen any kind of big money use a 75 or 100-day moving average. Anyone that can move the market is not going to be using those averages. So, what is the relevance then? What would the relevance be of those moving averages? Zero. Good answer. There is no relevance. So when I do take a peek and I see an average that they're using to prove their point, I do worry about some of the information they're using here. But I did like this article because there's quite a bit of information that they've gathered here for me to make a decision. And this is the chart that really caught my eye right here. They have some of the crashes. Anyone notice what's missing between 1974 and the 1987 crash? Again, this is why you need to gather the information and use your own 2 cents. Where's Black Friday in 1983? Aha, they've missed one, right? They've missed one in here. Dot bomb, financial. It's funny, it seems like every 8 to 10 years we have some crashes. They have the 74, there's a 79 oil crash that's probably right here. I'm going to assume this is probably the 83 Black Friday, 1,000 point in a day. There are some crashes that aren't listed here. Obviously, it's not listed because it doesn't fit their long-term thesis. But where I'm going at with it, go ahead and take the information, and you can see down here on their version of the MACD, big crash in the dot bomb. We don't have the crossovers, but when you're higher up on a percentage basis, you're going to have a bigger crash on the way down. So, pretty interesting as I went through some of the data. I appreciate these guys for gathering it. In fact, if you go and you take a peek, these guys are, it's written by Lance Roberts. The Real Investment Daily is where I picked this one off of. But kind of found interesting because, yes, they do slant things their way, which is okay. It's just not 100% correct in the way that they do it. I'm kind of fun. I do like their little risk management analysis. All it's showing is we created a new trend line on the top trend line that is now support. Kind of some imperfluous information, but where's the one all fanged up? I used that one already to show you. Where's our GDP? There we go. 10-year average real GDP growth. When you take a look at the 10-year average real GDP growth, which is growth that comes strictly from the companies, not coming from trade wars, taxes, increased government spending, the Fed, what do you see on an average real GDP growth rate right now? What do you see? Looking at that chart, what do you see? Okay, it doesn't look good. Why does it not look good, Mary? What do you mean it doesn't look good? What do you see there? down, okay, declining. And in fact, in all honesty, this 100% justifies what President Trump sees in regards to unfair trade. We are making more, selling more, yet we have less and less real growth, real company growth here in the US. If you dissected this chart, everything that President Trump is worried about from international trade can be proven by this one simple diagram. I really wish he'd go about I really wish President Trump would go about the way he talks to people and the way he wants to get things done is not the same way I would do it. It's brutal. But is he right? He is. He is right. I just don't like his tactics on the way it's getting done. But this is the first time in 40 years, 50 years, maybe since Kennedy, that we've had a president be so forceful on trying to right our economy. This chart worries me. What does this chart mean for our stock market? What does this chart mean for our stock market? So the comment was just made, Kevin, that's not a fair question to ask. And obviously you wrote something before it, so let me give you a second. Not sure I understand what you mean by it's not a fair question to ask. Okay. So he asked that I keep the question to myself, but let me rephrase it in a way that I think you're trying to get to here. So my comment was, we almost went into Kennedy was the Cuban crisis, right? He also had issues with Russia. We have a president since Kennedy that's maybe not so politically motivated, that's willing to call it the way it is. And unfortunately, we have a government that, in my opinion, whether you're Republican or Democrat, that seems to be, as of recent, and I don't have a timetable, but they seem to be in it for themselves. I'm not happy with how much money the Clintons seem to have gotten for their foundation. I don't understand where Obama got all his money. If I was to pick on the Bushes, second Bush to finish off the war that his father couldn't do in his presidency. Not maybe a reason I would send our troops into the Middle East. I really like having a big stick. I like that we're going to spend more money on defense. But that doesn't mean we have to wave it or use it around in some of the political arenas in the world. In fact, if it was left up to me, I would just let the Middle East, let them go to town on each other. Let them reduce the population by half in those areas. No worry on my part. It would be less risky than putting our troops there. A couple comments here on why this is going. Keeve just says, okay, Thanos. Keeve, I'll talk with you later. A couple comments that are affecting the GDP. Debt, spending hikes, demographics, surging healthcare costs, structural employment shifts, technological innovations, globalization, financialization. Pretty interesting article for you guys to read. I'm not going to spend too much time with it, but here's where I'm going to get at. If I can just make one comment. My fear is that the next correction, which is only supposed to be 10%, right, may be more than just a bear market correction, which is 20%, right? Correction in itself is just 10%. I'm not going to be a Rand Paul, so to speak, but I could definitely see and mathematically see a 35 to 50% correction next time around. Anyone want to make any comments? So what brought me to this conclusion, or this talking, right? Well, it's pretty simple. I'm going to leave that one there for you guys to see. So this week, I'm traveling, and let's get this so we have this week I'm traveling. Come on, Hurley. And spent 25 hours on the road. Listen to every political and financial talk show to pass the time. And I listened to the NFL Hall of Fame inductees, right? The inductees talked about pain and how hard it must be to, live with millions of dollars. I didn't take it the right way. Obviously, they've spent hours going through practices. They've been hurt with injuries on the field, multiple surgeries. But all I've heard about this week is pain. And some of the pain that we deal with as financial advisors are daily returns. I hate daily returns because when we start, everyone asks us about our yearly returns. But our phone calls are never really about a yearly return, it's about a daily return. And in all honesty, daily returns come right down to portfolio creation. Being right in a time frame that the clients can handle. Out of curiosity, I'm going to ask this group, what do you think my biggest mistake has been? And there is one of you that is in here tonight. There are two of you that are in here tonight that has lived with me through my biggest mistake. What is it? Okay, I see a couple question marks. There are two of you out of the 15 that are here. 17, used to be 17. Not collaring? Nope. There are times I wish I was collared, especially when Disney does what they've done today. But we're okay. We're protected up at 115. Good question. Good idea. Keeve, you work with me. Overprotecting, that's another good one. Overprotecting for a known problem that's coming up and not meeting the time frame again, right? Not having it happen. That is a good one, but that is not it. Those are both great ones, Maud. Thank you. What might be my biggest mistake? So a mistake is where I've done something wrong. Not exactly where I didn't know better, but did something wrong. So two of you are here. People ask me all the time why I'm sitting in Ford. Love it, Maud. People ask me all the time why I sit in Ford. Kevin, you sat in Ford for 4 years. Yeah, there are some people that have 300 times more shares of Ford than when we started. And I'm about ready to add some long calls onto Ford. But my biggest mistake was years ago when Boeing would trade between 76 and 87.5 dollars. And I believe I sat in it for about 2 years. Did a good job, probably picked up 40, 50% more shares of stock in this little 10% range. Told people, hey, the Dreamliner's coming out. We're going to be in good shape. We just need to wait. And I caved to pressure from some clientele. I caved to the pressure on, what are you doing? You got to get us out. There's Google, it's going to $1 million, and this Amazon company, and Deer and Cat. I mean, it is ridiculous. And I caved and said, you know what? Let's get out of Boeing. Let's go to something else. And can anyone tell me where Boeing is at today? Yeah, it's only sitting at $350 a share. Now, I wouldn't have made all that up, but that's only a 500% return. And I might have used up 100% of it. So I might have only had a 400% return. Oh, but I had 50% more shares of stock, so I'd probably have a 600% return. And I got out of Boeing because I caved to clientele pressure. What I should have said, relax. And I bet you I got out probably right here in August, September. And I could have gotten back in. We were getting out at a profit or a break even. It wasn't a taxable event. I could have gotten back in. But Hurley Investments, out. Did I miss it? Yep. When all I had to do was stand my ground. My mistake was not getting out of Boeing. Getting out of Boeing was not my mistake. I got out for great reasons. Reasons that everyone could understand, reasons that were justified. Getting out of Boeing was not my mistake. My mistake was succumbing to client pressure. I should have told the clients, if you don't like it, go somewhere else. And I could have called them in a year and said, hey, just double the portfolio. But I blew it. Maud, I love you. I've got a couple of comments coming in from Maud and Lance, and I'm holding for myself, but yes. So where I'm going at with some of this is a little phrase that Michael Verdon put together, and he's right. When it really comes down to it, when you take care of the risk, the profits will come. And they're 100% correct. So, where will we end this week? If you ask me, I think we're going to go down. The reason why we're going to go down, nothing more than technically we're bullish on the Dow Jones, but we're just approaching that overbought territory. So we'll bounce off of it. Technically, we're bullish on the S&P. Approaching that overbought territory, we'll bounce off of it. Technically, we are moving higher to some highs on the NASDAQ, probably bouncing off of it. Not to mention Disney. Disney missed earnings, and with them missing earnings, they were down as much as $3. They're finishing down after hours 0.5%, only 58 cents. So maybe not. Maybe we'll see Disney bounce back. Let's hear it for a good call on Iger. And we're still technically bearish until we get our MACD crossovers. But we're trending bullish again. We don't have a whole lot going on this week. Kind of disappointing to see today. Consumer credit came in at only like 10.2 billion instead of an estimated 15.5 billion. So people are not using as much credit. I still think August will be bearish, and I'm really worried about September, October. August is our third our third weakest month. I'm pretty sure it goes October, February, then August. Maybe it's September. September's our third. Never mind. I take that back. Pretend I didn't say that. But yes, some things worry me that as we get into our historical, hey, not much happens as we see inventories build for Christmas. A comment was just brought in by Bill. He's absolutely correct. Isn't there a historical tendency for late summer and autumn pullbacks in the midterm election years? Not only for midterm election years, but usually we'll see September, October, October being your worst month in the year, September being your third worst month in the year, February is number 2. So yes, typically you'll see a historical late summer correction which bounces you into a Christmas rally. And it's not just in midterm election years, but you can see an even bigger drop. By way of earnings, we have Disney, Wendy's, PPL today, Emerson today. Tomorrow, CVS, Coors, Dun & Bradstreet, Jack in the Box, Flowserve, Murphy Oil, Monster Drinks, Roku. Not a whole lot's happening. We do have some inflation that's coming up. A lot of people worried about Friday inflation. I haven't written anything down for a couple weeks internationally. I don't see a whole lot going on. I'm still in callers, but I put in here on my bullish stocks, I was bull putting my long puts. In the bearish stocks, I created bear puts by adding short puts below my long put. And someone did ask, because they made a comment on how stupid they thought I was on Facebook. If you guys remember last week, this was down at $20. We basically picked up $7.80. Yes, we're still down in the position that we put $40 into. But I am just about ready to add another position on. It'll lessen how far it has to go up. I still have till June 2020. So if someone were to ask me how bad I'm eating it, I just made $7.80 per contract back this past week. I'm not really worried about my Facebook position I showed you guys last week. Let's see what else we have. Interesting article on tech stocks should still be in a portfolio. It's from Deutsche Bank. And with that said, any questions I can answer for you guys? Any questions you guys have that I can do my best to answer for you? Talk about Disney. All righty. So Disney was down as much as $3 or so. Obviously, they had their earnings call, and Iger put some fears to ease. Content is king. And Disney owns a lot of content. They are a lot of content. So the short answer is content is king. Not a whole lot of worry about Disney. I haven't gone through everything, but plain and simple, it's the same old story. They're still losing people to their media. If you do some research, ABC does not have a lot of the top 20 shows. I think they're number 3 in one show, and then they fall into that, 10 to 18 range is where their other shows pop up. Out of the top 20 shows that show up each week, ABC, which is owned by Disney, is getting butt kicked by NBC and by CBS. I don't know why they focus so much on CNBC or on ESPN, excuse me. As I do my research, this big drop is less than like 0.4% of their overall revenue and profit. So it's not a big deal, but it's been made out to be a big deal. They're doing good in all other aspects of their business. Another couple $1 billion movies that came through this time through. So I would like to see Disney head higher. Tomorrow morning will be an interesting comment to read on Disney, and I'll have to read through their report to see and pick out the weaknesses. I'll probably talk more about it next week. But for those that are here next week, I might do I might be on the road traveling back, so I might push next week's chat session to Wednesday from Tuesday. Is Apple a growth or a dividend stock? It's both, Ida. Apple still has a good paying dividend. And you're probably saying, is it a growth or a value stock? Its valuation still calls it a value stock. It's not a growth stock. It hasn't had a valuation of a growth stock for forever. But we've had some nice growth in Apple. So if you were to ask me, is Apple a growth or a value stock? It's both. But the market has treated it as a value stock, a very low valuation multiple, price per earnings multiple, and that's why it hasn't grown so much in past years. It's nice to see it growing right now. It is a safe haven. We did have a bit of a drop in it today. For new positions that I got into, I've got some that I started off buying the stock at 198, and I've got 205 covered calls, and I've got 210 covered calls on it. So I tried to be cautious as I added a few new positions in Apple. It did take a 1% drop almost, $1.96 today, and it also is down 23 cents after hours. So basically today it's losing a full 1%. That is most likely going to be a little beneficial for Apple because, in all honesty, any pullback on Apple is going to be a buying opportunity for anyone that feels like they've missed the boat. It'll also be a buying opportunity for any funds that need to rebalance and put more Apple into it. But all I see is nothing more than Apple right now coming off of an overbought technical correction. So Ida, hopefully that answers your question there. And Mary asked, would you buy more Apple? Yes, again, right after earnings, I did sprinkle some Apple into some new accounts, but I went in with September 205 and September 210 covered calls to give me some protection with what I might be fearful we see in September and October. Also, just out of curiosity, the ex-dividend date was going to be 8/10. So we'll see a dividend payment to those in Apple on the 10th. I don't remember when we're supposed to be there. Maud, I heard on CNBC today a lot of financial advisors are getting calls from their clients to buy. That is true. Kind of funny. If I can go ahead and bring up the S&P again, a lot, big telling point, right? What can I do? I'll just use the chart right here. When you have this kind of run, and again, I'm going to pick on the media, and the media portrays this huge 20% return, which it's obviously not 20%. But when you see that kind of big run, It's always the client that close to the top are all of a sudden willing to take more risk. Not willing to take the risk appropriately positioned right here. Well, Kevin, how do you take that risk? Well, I cash in my long puts somewhere in this area, and I buy more shares of stock. Occasionally, I have to dollar cost average. I have to add puts back on, but usually it's in this area that the purchasing and buying has to occur to make these kind of returns. So it's funny because up here we get the calls to buy, right? What do you think I get down here at the bottom where they should have been calling me? Sell everything. We just had a drop of like 4.5%. Sell it all. And in all honesty, that's a difference between, that is the beauty for me of managing other people's money. I can't think like a retail investor down here. Because I can't think and act that way, I have to manage my money the same as everyone else's. I get to buy protection. I get to add more shares. I get to keep going. We did some adding of shares here. If I'm wrong, I've got to get my protection back in place. If I'm right, I can look pretty good. But yes, a lot of clients are saying take ridiculous risk, which just shows me again a good September, October pullback that could be huge is probably in the works. And yes, new money and people I talk to, I'm hearing just let it run, and I kind of scratched my head. I do see the same thing, and yes, it usually is a precursor to a short-term top. Not really a long-term top, but yes, it is usually a precursor to a short-term top. Any other questions I can answer for you guys? Hopefully that answered the Disney question. Maud, hopefully I've got your questions answered. Nida, I think I got your the Apple question there. Lance, I should have answered your Disney question as well. I really don't know where it's going to be, but I'm going to read through this stuff. Tomorrow will be a very telling day on Disney. All right, guys. Hey, have a great week. I appreciate you being here. Next week, prepare to see maybe Keith take over. Next week, I might postpone a day. I'm not sure. But Tuesday looks to be more of a travel day. So most likely, I will have some email announcement out for you on when I'm going to do this, our chat session for next week. Guys, take care. Appreciate your time. Have a wonderful evening. I look forward to seeing you again next week. Bye-bye.